Chapter 6, the budgeting process. This is Managerial Accounting, BADM 212. This is Professor Bolt. We're going to talk about the budgeting process. Lots of very important information when we talk about budgets. So what do you know about budgets? Some people know about the federal government budget and the deficits. Some people know that schools or other nonprofit organizations have challenges with the budget. You hear about it in the news a lot. Some families discuss openly their family budget for things like automobile expenses and mortgages or rent, and the electric bill and the food budget, vacation budgets. In this narrated PowerPoint, we're going to talk about budgets for the manufacturing process. Managerial accounting focuses on the manufacturing process because it's more complicated. Once you understand manufacturing budgeting, you can move forward to understand more about what goes on in service and retail budgets. So here's an example of the Citadel's budget. It's not easy to see. I know it's small, but you can actually Google and find this. So here's the Citadel's mission, and here's their 2015-16 executive budget recommendations. And here's a list of actual and the executive budget. Lots and lots of complicated components to a governmental budget because, of course, there's no revenue. It's talking about everything from jobs to personnel. Here's employer contributions to employee benefits. Just a tremendously complicated process that goes on each year to ensure that the Citadel as a college is able to allocate their funds in the way that focus on their mission. And that is actually an important part of the budgeting process. So underlying a budget is the fact that this is an action plan, and it should match with a company's organizational goals and tying their resources to meet those goals. The formal definition: identifying, gathering, summarizing, and communicating both financial and non-financial information. That non-financial information may have to do with the number of units produced. And it's related to an organization's future activities. The advantages of the budgeting process are numerous. You can look at the list here. I think a primary one is the goal focus, looking after the fact of whether you did a good or bad job and whether you varied off the budget much, ensuring that you focus on what's going on in the future, because if a company has no budget, then who's to say that they don't run out of money towards the end of the year or the end of the period. A master budget is where we're going to start, and it has both the operating budget and the financial budgets. So the master budget, two parts. Operating budget changes depending on whether you're service, retail, manufacturing. The financial budgets, though, are the same for all types of companies. So it depends on the company. Again, here's our three different types. So let's look at the way they play out as you look at the organization of the operational budget and the financial budgets. This is for a service organization, and this service organization has labor and overhead. Notice they have no materials. Their operating budget's not too complicated. Again, a service organization might be a law firm, a doctor's office, an accounting firm, a real estate commission office. And here's the 4 financial budgets that are common in all budget types for all organizations. Here is retail. This is the Walmart type of store, gas station, where you're selling a product. So you have a sales budget, purchases, cost of goods sold, SG&A, and then the same 4 types of financial budgets. Finally, we get to the manufacturing budget, more complicated. Again, notice at the beginning of all of these, sales budget. But then we make a production budget up that's going to be starting point for materials, labor, and overhead, which will feed into the cost of goods sold budget. And then the SG&A is going to be on the side. Finally, we go to the 4 types of financial budgets. Okay, so the first step in every budget, this is one of those things to highlight. When you prepare a budget, you always start with sales. So let's try to put a little personal analogy to that. If you were trying to figure out a budget for your summer internship, let's say you've got a summer internship in Charlotte, you're looking to have to pay for rent and food and the electric bill and the internet and all of those expenses that seem to add up. And whenever you do a sales budget, that's where you start. You have to figure out, if you're an individual trying to figure out your summer costs, how much money you're going to make. That money that you're going to make will help you to budget everything else. Again, the same thing in manufacturing. Take the selling price per unit times how many units you expect to sell, and that will tell you what your sales budget is. So let's look at an example for this company. This is the Frame Craft Company. They've divided this company into quarters. They plan on selling 90,000 units of their product for the year. Here's the way the sales budget breaks out, and each sells for $5. So their sales for the year is $450,000. After you've figured out how much you're selling, then you need to figure out how much you're going to produce. And it's going to help you meet your sales, but also inventory needs. I've got this in large red print because inventory is important. You can't just produce what you're going to sell. Because remember the key word in this? Estimate. This is all an estimate. So you're estimating your sales, but from that you've got to estimate what you're going to produce, which will include ending inventory. So you can start the next period, in this case the next quarter, with the proper amount of inventory and storage. And there's going to be a desired amount. So look down here at the formula you need to memorize. Desired units of ending finished goods inventory. So you're going to add the amount of desired ending inventory you want and subtract the beginning inventory from the prior period. So you produce based on what you want to sell, plus what you want to have left over at the end of this time period, but you will subtract out what you anticipate having in your beginning inventory. So let's take a minute and try to translate this into a personal situation. Okay, our example is going to be a man who is planning his weekend. And he's going out of town to visit a friend for the weekend. And he anticipates that he's going to spend $100. Okay? And he would like to have at least $15 left over in his wallet on Monday so that he's not completely broke. So at this point, he needs $115. $100 to spend for the weekend plus $15 for the leftover. The next thing he's going to do that keys into this beginning cash and wallet, he's going to go look in his wallet, and if he goes, oh, well, this is good, I've already got $10 in here, then he can figure out how much cash he's going to need. So the cash needs will be the $100 to spend plus the $15 that he wants left over, that's $115. Subtract out the $10 that's already in there, and he only needs to get $105 out of his bank account. Hopefully that kind of connects this concept in production. Okay, so this one is the first of many slides that shows the layout of how to do a budget. Notice the arrows. I'm going to switch it over and add some more arrows to this. Let's see. First, we're going to show this. Sales in units matches our sales budget. Desired units of ending inventory is a formula, and that formula is 10% of the next quarter's anticipated sales. So notice that 3,000 is 10% of 30,000. 1,000 is 10% of 10,000. 4,000 is 10% of 40,000. Okay? Another thing to notice as you build this model, this could be done very easily on an Excel spreadsheet, is that your desired ending inventory will become next month's beginning inventory. And if I can do this, it's going to be subtracted. So you have to add. It's very hard to draw on these PowerPoint slides with a mouse. You're going to have to add what you hope to have left over based on what was told. And in this case, we are told, hey, we want 10% of the next quarter's sales left over. So here's the way a production budget goes. Let's look at the second quarter, okay? In the second quarter, go to the highlighter. In the second quarter here, our sales budget shows that we need 30,000 units, plus we need another 1,000 in ending finished goods inventory. The reason for that is that we have been told by management, and this will be told to you in a problem, that we need to have 10% of the next quarter's sales. So now suddenly we need to produce 31,000. However, we have that same model that occurred from the last period. We've already got included in our beginning inventory 10%. So suddenly our production becomes 28,000 units. At this stage, sometimes I think it's wise for students to go look at problems in the back of the chapter, the short exercises, see if. Okay, moving on. Direct materials budget. This is going to identify the amount of purchases of direct materials to meet our needs. And here's the other part, not just our production needs, but also our inventory needs. Okay, so we have to look at how much we need to purchase times the cost per unit, and that will tell us how much the dollars will be. Here's our caution. Read through this. It's what we've repeated on a prior screen. Same as before. Go backwards. Sorry. So this one is a little bit trickier. So production, 90,500. This comes from the production budget. So all these budgets link. This comes from the production budget. We're going to be told that we need 10 ounces for each one we produce. So now we know how many ounces of this product we need to buy for our direct materials. From there, here we go again, we have desired ending inventory. Notice it's going to become the next period's beginning inventory. And if you look at the relationship here, you'll see that desired ending inventory is 20% of the next quarter's production needs. Let me say that again. Your desired ending inventory is the next quarter's production needs times 20%. So, sorry, wrong option there. So this is an addition. So I have 120,000 here, and I need another 56,000 because I need 20% of next quarter's production needs. Suddenly, I have to have 176,000. However, we've got some beginning inventory in here. This beginning inventory, by the way, is 20% of this quarter's production needs. So 20% of 120,000 is 24,000. So now suddenly we need to buy 152,000 at 5 cents, and the cost of the direct materials purchased will be. Okay, moving on. Just as an added comment, if you really are trying to help yourself understand this as we go from slide to slide, I would suggest you pause, look in the back of your loose leaf text, or possibly you're using the ebook, and figure out a short exercise that helps you prepare and asks you to prepare a production budget. We're now going to move to the direct labor budget. little bit simpler, as you'll see. Sometimes simpler just means there's not quite as much writing on this one. So again, going back to the production budget of $90,500, it takes 1/10 of an hour, which I guess is 6 minutes, to manufacture one. Their labor costs are $6 an hour. Multiplying it out, we figure out that we're going to have $7,200 for this quarter, and it goes all the way. The overhead budget. This budget is going to help us figure out indirect costs. Let's go back as a review. An overhead is what is all of our indirect costs, those costs that it's not convenient or economic to trace. And as we look at the overhead budget, boy, this is a big one, isn't it? Don't let it scare you, just like it kind of scares me sometimes when I think about you being overwhelmed. So again, if this is our production, we're going to split our overhead into two parts: variable and fixed. Go back to your Chapter 5 definitions of what is a variable cost and what is a fixed cost. And really that's all you need to know, is that the fixed costs stay exactly the same. Let me show you something interesting here. Every single quarter, the exact same amount of fixed costs within the relevant range, but this gets progressively higher depending on. Selling and administrative budgets help us with operating expenses not related to production. Again, remember, this is all. And here's our SG&A expense budget. Notice this. Again, variable, fixed. Absolutely no change in the fixed costs, but the variables change with a varying number of sales units. Okay, cost of goods manufactured, moving along. Because really the most important concept I need you to know from overhead and from SG&A is the fact that there are two components, variable and fixed. We will not be preparing those in this course. We also won't be preparing this cost of goods manufactured budget. But it is interesting because it's just a culmination of all of the budgets from the prior slides. Materials purchases has units and dollar amounts and labor and overhead for us to figure out cost of goods manufactured. Budgeted income statement based on all of this information: sales, direct labor costs, material costs, overhead costs, SG&A. Then we can prepare a budgeted income statement. And you will not need to prepare a budgeted income statement, but you do need to understand that all of these prior budgets feed into this budget. There are lots of interesting Excel spreadsheet projects that can be done. And if you're watching this and if you're interested in learning more about putting together a full budget for extra credit in the course, please send me an email and let me know that you would like to try the Excel spreadsheet extra credit budget. It's multiple Excel books. None of the entries are made by typing in a dollar amount. They're all linked. It's quite a helpful budget for enhancing your Excel spreadsheet skills as well as your budgeting skills. While we won't be doing a capital expenditures budget, it's an important budget for looking at how much money we'll spend long term. I always think of the fact that families do this type of budgeting. An individual will say, okay, when am I going to be able to afford a house? What's my down payment going to be? Maybe the same for an automobile. How am I going to pay for a car? So the capital expenditures budget anticipates what needs to be spent. Cash budget. Now it's time to wake up a little bit. This is going to be one that we prepare. And this is a cash receipts budget that we're going to start with. How much do we think we're going to receive? Subtract out how much we think we're going to have to pay, and we can add to it how much we want in our balance to figure out our ending cash balance. So let's start with cash collections. And first you have to always look at the rules, quote unquote. There's always a rule, and in this example, with this Framecraft example, the first rule, cash sales are 20%, everything else is 80%. So that means if Framecraft sells a product, remember their sales price is only, I think, $5 a unit, if I'm remembering from the prior slide. So if Framecraft sells a product for $5 and they sell 100 of them, then they would like to get the $500 in, but only 20% of those are going to be cash. They're only going to collect $100. The other $400 is going to be on credit, which means that their customers are charging a lot of their sales. So the next step is, well, how long does it take you to get your cash for people that said charge it? Now, this is not a credit card, remember. This is people that say, I'd like for you to bill me later and I will pay later. So here's the next rule. Experience shows that they will collect 60% in the quarter that it was sold. So that means that maybe the customer bought something in January and 60% of those customers will make the payment by the end of March, the end of the first quarter. Then 30% of the customers will take 2 quarters, and 10% of the customers will take 3 quarters to make payment. Just as a heads up, on one of your homeworks, they actually have embedded into the homework assignment something very realistic, and that is that for the customers that are paying really late, they're going to have to pay a fee or a late fee. So keep that in mind as you go through. Let's get back to Framecraft. Okay, so here's the way we have it. We have accounts receivable and we have cash sales, and they're spread out. And so this $40,000, as we've indicated, the $40,000, $24,000, if that's our first quarter credit sales, $24,000 will be in the first quarter collected, $12,000 in the second quarter, $4,000 in the third quarter. So what you see is that each quarter follows the rules that we talked about on the prior slide, showing how long it takes for customers to make their payments. And as you lay out your model, this one's a little more complicated than the homework, definitely more complicated than what we'll do on an exam. But as you lay out your model, you just have to pay attention to those rules and write them in the margin of your exam as you consider the options. Please remember too that every student's going to have a different model. It's algorithmic, so every student that takes exams is going to be having a different set of problems. Okay, cash payments. Of course, this is very similar, except now instead of accounts receivable, we're going to be dealing with accounts payable. So let's look again at our quote-unquote rules. Here are our rules. Framecraft pays 50% of their bills in the quarter that they make a payment, and the other 50% in the following quarter. So if an invoice comes in and Framecraft has purchased something, half is paid that quarter, half is delayed. And so let's summarize this in the next chart and see what we've got. So first quarter, $3,800, they're going to have to pay that out first quarter and second quarter because it was $7,600. So that $12,500 here will be split second and third. In the third quarter, if this is the amount of accounts payable they have, it will be split here and here. We can obviously tell that this is the leftovers from the fourth quarter of the prior year. So a schedule of expected cash payments. In case you're wondering, as many students do, oh, what is she going to ask me on an exam? Do we have to fill out one of these charts? Typically, the requirement will be to be given a lot of data to narrow it down to do a calculation for just one quarter. So I might have to give you all 3 quarters worth of data here, excuse me, all 4 quarters, and I may say, okay, what is the expected cash payment for quarter 3? And you'll have to pull out the important data, ignore the unimportant data, and complete cash payments. All right, this is scary. It scares even me. I don't think we'll be doing this one in this managerial accounting class as an intro. If you're an accounting student, accounting major, you will probably do something this detailed. It will probably be done on an Excel spreadsheet, and you'll be doing it in your upper level managerial accounting class. This is the cash budget, and you'll notice that it's just showing how much money is going to be spent, and it's built based upon all of these different budgets all found out in here. So, no worries. Little tricky. Even has ending cash balances becoming the next quarter's beginning cash balance. That's for another course at a higher level for another day. Okay, lots of companies have to maintain a minimum cash balance because they have to be careful. You never know if the economy is going to do something strange or your customers are going to cause problems. You don't know if maybe you are a resort and it's a holiday weekend and there's a thunderstorm that comes through and you don't get the cash flow that you thought you were going to, and so everything changes. So all of that has to be taken into account as far as keeping up a minimum cash balance. And usually that's where a line of credit comes in. We've talked about line of credit in other chapters. Maybe it was in 211, financial accounting class. But if ending cash balances fall short, you have to borrow the money. And alternately, if somehow you go, wow, look at all this cash I have, you don't want to have it sitting around. You don't want to start suddenly paying out bonuses because you might want to save that type of thing for a rainy day. So in this case, you invest. If ending cash balances are significantly larger, you invest. So these are important rules always. Budgeted balance sheet, again, you can see the source of data. Again, we will not be preparing a budgeted balance sheet for this course, but you can see how all the other financial statements build into this budgeted balance sheet. And so there you have it. Let's move and talk more about the budgeting process. The most important thing, as we talked about at the very first of this narrated PowerPoint, budgets have to tie to a company goal. Does the company want to expand to another city? Do they want to give large bonuses to their employees? Do they want to pay dividends? Are they trying to save money on the side because they're concerned about a lawsuit? It's corporate goals, and that's what drives the budgeting process. It's an important part of every company. Budgeting authority, generally there's a budget manager. The Citadel has a budget officer, and each year that budget is prepared and presented to the Board of Visitors and to the administration, where they make decisions about where the money's going to go. How are they going to be able to afford this project? Do they have enough money to send students on this type of engagement? Can they hire new faculty? Can they start a new program? So budget authority talks about the fact that there usually is one person who's the bottom line person, but participation is so extremely important that everybody at every level is engaged. In a traditional budget, managers just prepare 1 year at a time their budget. Okay, here's the year's budget. And actually the Citadel has a traditional budget. Once a year, they justify. Zero-based budgeting is a very important one, and it says we don't need to look at last year's budget and raise it 1 or 2%. What we need to do instead is say, what are our needs this year totally, and build from the ground up and justify every dollar amount. Budgeting is a very tedious, time-consuming, and costly and intense process. There are static budgets that are prepared once a year, the traditional kind, and continuous budgets, interestingly, are called rolling budgets. If the month of May has just ended and you're now in the month of June, then you'll start preparing the month of May's budget for the following year based on the information about what occurred with your sales during the month of May in the current year. Finally, for budget implementation, generally it's top management with the high level of responsibility. It's delegated. For example, at the Citadel, each of the 5 schools, the School of Business, Engineering, Education, Humanities, etc., each school has its own budget. And as each school has its own budget, they have to communicate very clearly what the budget process is going to be and what the budget needs are. And communication is the key. The old line of thought was employees don't need to know about the budget. The new school is that, well, strong communication, transparent budgets are the most important thing out there. This is the last slide. Good luck with your homework. Good luck with your quizzes. And let me know if there's anything I can do.